Negotiable Instruments Act, 1881. 1. Simple explanation. The Negotiable Instruments Act, 1881 is a law that governs financial documents like checks, promissory notes, and bills of exchange. These documents allow people to transfer money easily without carrying cash. The Act ensures smooth transactions and protects both parties in case of disputes. 2. Key concepts with examples. Negotiable instruments, documents that can be transferred from one person to another in exchange for money. Example: a check signed by a person can be given to another person, and they can deposit it into their bank. Types of instruments. 1. Negotiable instruments can be freely transferred. X. Checks, promissory notes, bills of exchange. 2. Non-negotiable instruments cannot be freely transferred. X. Share warrants. Example: a bank check is negotiable, meaning anyone with a properly signed check can get money. But a share warrant needs legal procedures to transfer ownership. Endorsement and delivery. Endorsement, signing the document to transfer it to someone else. Delivery, handing over the document. Example: if A signs a check and gives it to B, B can either use it or pass it to C by signing on the back. Endorsement. 3. Important points to remember. This act was passed in 1881 to regulate negotiable instruments in India. It follows the Mercantile Law of England. Promissory notes, bills of exchange, and checks are the main negotiable instruments. Negotiable instruments can be transferred freely unless restricted. 4. Short trick to remember. Use the word need. Negotiable instruments, E. Endorsement and delivery. E. England law, basis of this act. Different types, negotiable and non-negotiable. This will help you recall the key points during exams. Objective of the Negotiable Instruments Act, 1881. 1. Simple explanation. This act was created to legalize and regulate the use of financial documents like checks, promissory notes, and bills of exchange. It ensures that these documents can be transferred easily from one person to another, just like money. Key objectives with examples. Legalization of negotiable instruments. The Act ensures that financial documents can be used as legal proof of payment. Example: if A gives a signed check to B, B can deposit it in a bank without worrying about legal validity. Easy transfer of instruments. These documents should be easily transferable, just like cash. Example: a check signed by X can be endorsed, signed at the back, and given to Y, making Y the new owner. Protection and privileges for businesses. Businesses should feel secure using checks and promissory notes in transactions. Example: if a check bounces, the Act allows the affected party to take legal action. Special procedures for non-payment. If a payment is not made, the Act provides legal action to recover the money. Example: if a check issued by a company bounces, the payee, receiver, can file a case in court. Important points to remember. This act makes financial documents legal and transferable, helps businesses use checks and promissory notes safely, provides legal action for dishonored payments, ensures fast and secure money transfers without cash. Short trick to remember. Use the word let's. Legalization of financial documents. Easy transfer of instruments. Trust and protection for businesses. Special procedures for non-payment. This will help you recall the key points quickly. Commencement of the Negotiable Instruments Act, 1881. Simple explanation. The Negotiable Instruments Act, 1881 started on 1st March 1881. It applies to all of India except Jammu and Kashmir at that time. The Act covers 3 main financial documents: promissory notes, bills of exchange, checks. What is not covered in the Act? Indian Paper Currency Act, 1871. The Act does not cover government-issued currency, like rupees. Local traditions in Oriental languages. If there is a special local rule for a document, e.g. hundi, this Act may not apply unless no custom is established. Example: If a business in Rajasthan follows a traditional hundi system for payments, this act does not interfere unless there is no local rule for it. Key points to remember. Started on 1st March 1881. Covers promissory notes, bills of exchange, and checks. Does not apply to government money or special local rules, like hundis. Short trick to remember. Use the word PBC. Pete, promissory notes, bills of exchange, checks. This will help you recall the main financial documents covered in the Act. Special local rules. Negotiable instruments, meaning and definition. 1. Simple explanation. A negotiable instrument is a written document that can be transferred from one person to another, just like money. Negotiable can be transferred easily. Instrument, a legal document that gives someone a right to receive money. According to the Act, Section 13(1), it includes promissory notes, bills of exchange, checks. 2. Key features of a negotiable instrument. 1. Can be transferred easily by delivery or endorsement. 2. New holder can sue in their name without informing the original party. 3. If received in good faith, the new owner gets full rights, even if the previous owner had issues. Example: if A writes a check to B and B gives it to C, then C can collect the money. Types of negotiable instruments. 1. Payable to order, paid to a specific person or someone they choose. Example: pay A or order, pay to the order of A. If it says pay A only, it cannot be transferred, not negotiable. 2. Payable to bearer, paid to anyone who has it. Example: pay A or bearer, pay to bearer. If A signs a check without writing a name, anyone can cash it. Example: if a check says pay to A or bearer, anyone who holds the check can collect the payment. 4. Short trick to remember. Use transferable easily. Oak, order, pay to a specific person. Bearer, anyone holding it gets paid. This will help you recall the key points of negotiable instruments. Nature and characteristics of negotiable instruments. 1. Simple explanation. Negotiable instruments like checks, promissory notes, and bills of exchange have special features that make them easy to transfer and use in business transactions. 2 key characteristics. 1. Written and signed. Must be written and signed by the person issuing it. Example: a check must have the account holder's signature. 2. Payable in money. Can only be paid in Indian currency, not goods, services. Example: a promissory note promising 10,000 is valid, but one promising 10 bags of rice is not. 3. Freely transferable. Can be given to another person easily. Order instruments need a signature delivery. Bearer instruments only need delivery. 4. No defects in title. A person who receives it in good faith is protected, even if the previous owner had problems. Example: if A gives B a check and B gives it to C, C can still claim the money even if A had some disputes. No notice needed. The new owner doesn't need to inform the original issuer. Example: if A transfers a check to B, B doesn't have to tell A's bank. 6. Presumptions. Law assumes certain things unless proven otherwise. Example: if a check is given, the law assumes money was given in return. 7. Special legal process. If someone doesn't pay, legal action is faster than normal cases. Example: a bounce check can lead to a quick case in court. 8. Popular in business. Used widely in business because they are easy to transfer and secure. 9. Can be used as evidence. Even if a document is not negotiable, it can still prove someone owes money. Example: I owe you 1,500 U is not a promissory note but proves a debt exists. Hacks 3. Short trick to remember. Use WTF, TNPSEF. This note pays secure earnings. Written and signed, transferable. F. Free from defects. Tender. No notice needed. Presumptions apply. S. Special legal process. E. Evidence of debt. This way, you can easily recall the features of negotiable instruments for your exam. Of negotiable instruments. One simple explanation. There are two types of negotiable instruments. By law, statute, fixed by law. By custom, usage, accepted by business practice over time. Two types and examples. 1. Instruments negotiable by law statute. These are legally recognized under the Negotiable Instruments Act, Section 13. Bill of exchange. A written order by one person to another to pay a specific amount. Promissory note. A written promise to pay a certain amount. Check. An order to a bank to pay a specific sum from an account. Example. If you give a check to your friend, they can cash it or transfer it. 2 instruments negotiable by custom, usage. These are accepted as negotiable due to business customs. England's negotiable instruments. Exchequer bills, government-issued short-term bills. Banknotes, paper money, currency. Share warrants, a document that proves share ownership. Circular notes, used in international banking. Bearer debentures, bonds that can be transferred easily. Dividend warrants, documents that allow shareholders to collect dividends. Share certificates with blank transfer deeds, used to transfer shares. India's negotiable instruments. Government promissory notes, issued by the government. Bankers' drafts and pay orders, bank-issued payment orders. Hundis and delivery orders, traditional Indian credit instruments. Railway receipts, proof of goods transported by railway. Example. A bearer debenture can be given to someone and they can own it without additional paperwork. 3 short trick to remember. Use BPC GBHR. Big powerful checks give bankers huge returns. B. Bills of exchange, promissory notes. C. Checks. G. Government promissory notes. B. Banknotes and drafts. H. Hundis and delivery orders. R. Railway receipts. This way, you can easily recall types of negotiable instruments for your exam. Presumptions in negotiable instruments, Section 118 and 119. 1. Simple explanation. Presumptions are default rules the law assumes to be true about negotiable instruments unless proven otherwise. These rules make transactions easier and faster. Key presumptions and examples. 1. Consideration. The law assumes every negotiable instrument was made for value, money or goods were given in return. Example. If A gives a check to B, it is assumed that A owes B money unless proven otherwise. Date. If an instrument has a date written, it is assumed to be made on that date. Example. A check dated 1st March is assumed to be written on that day. 3. Time of acceptance. If a bill of exchange is accepted, the law assumes it was done within a reasonable time before it becomes due. Example. If a bill is due on 30th June, it must have been accepted before that. Time of transfer. A negotiable instrument is assumed to be transferred before maturity, before the due date. Example, a check given to a person before expiry is valid unless proven otherwise. 5. Time of endorsement. If there are multiple signatures, endorsements, it is assumed they were made in the order they appear. Example, if A signs first and B signs later, the law assumes A transferred it to B in that order. 6. Stamp. If a promissory note, bill, or check is lost, the law assumes it was properly stamped. Example, if A loses a bill of exchange, the court assumes it had the necessary stamp. 7. Holder in due course. The person who holds a negotiable instrument is assumed to be the rightful owner unless proven otherwise. Example, if B gets a check from A, B is assumed to be a genuine holder. 8. Proof of protest. If a negotiable instrument is dishonored, not paid, the court assumes it to be true unless proven false. Example, if a check bounces, the court assumes it was not paid. Short trick to remember. Use CDT ESHP. CDT test HP'd. Consideration, date. T, time of acceptance, time of transfer. E. Endorsement order. S. Stamp assumption. Whole H. Hold in proof of protest. CDT test HP. Think of it as a test for negotiable instruments to remember all presumptions. Promissory Notes, Section 4, Negotiable Instruments Act, 1881. Simple explanation. A promissory note is a written promise made by one person maker to pay a specific amount of money to another person, payee, at a fixed time. It must be in writing. It must have an unconditional promise to pay. The amount must be certain. It must be signed by the maker. It must be payable to a specific person or bearer. 2 examples. What is a promissory note? Valid promissory notes. 1. I promise to pay B 500. Clear and unconditional. 2. I acknowledge I owe B 1,000, payable on demand. Clear promise to pay. Not a promissory note. 3. I owe you Gully 1,000. No clear promise to pay. 4. I promise to pay B 500 and whatever else I owe him. Uncertain amount. 5. I will pay 500s if I get married. Conditional promise. 6. I will pay 500 after D's death if I inherit money. Uncertain event. 7. I promise to pay 500 and give my black horse. Includes goods, not just money. Short trick to remember. Use Whoops wrote you a promissory statement. Then written. Unconditional. Pat. Payable to a person. S. Signed by maker. Equals, think of it as I wrote you a promissory statement. Easy to recall. Characteristics of a promissory note. A promissory note is a legal document where one person promises to pay a specific sum of money to another person under agreed conditions. Here are its key features. 1. Simple explanation. Written instrument must be in writing, not verbal. Promise to pay clearly states a promise to pay money. Signed by maker, the person who promises must sign. Definite amount, the amount must be fixed and certain. Only money, no goods, services, only legal Indian money. Unconditional, cannot be based on if or maybe conditions. Specific payee, the receiver pay must be clearly mentioned. Fixed time can be on demand or after a fixed period. Not payable to bearer on demand. Only RBI or central govt can issue such notes. Examples. What is a promissory note? Valid promissory notes. 1. I promise to pay 500 on demand. 2. I promise to pay C 1,000 after 30 days. Not a promissory note. 1. I will pay 500 if I win the lottery. 2. I will pay 500 in a gold ring. Includes goods. 3. I owe you 1,000. No clear promise to pay. Chef. Short trick to remember. Use was funds. Think of it as writing you a strong fund statement. Written. U. Unconditional. S. Signed by maker. F. Fixed amount. U. Use money only. N. No verbal promise. D. Definite payee. Specific time. Equals writing you a strong fund statement. This trick makes it easier to recall. Parties to a promissory note. A promissory note involves 3 main people. Simple explanation. Maker, the person who makes the promise to pay. Payee, the person who will receive the money. Holder, the person holding the note, either the payee or someone to whom it was transferred. Example. Understanding with names. Imagine A takes a loan from B and writes a promissory note. I promise to pay 1,000 to B on demand. Signed Acre, the one promising to pay. B payee, the one receiving the money. If B gives this note to C, then C becomes the holder. Short trick to remember. Use think of money pays here. M, maker, promises. H, holder, has the note. MPH equals money pays here. Easy to recall. Bills of exchange. A bill of exchange is a written document that orders someone to pay a fixed amount of money to another person. Simple explanation. It is a written order to pay money, signed by the maker, given to a specific person, can be payable immediately or after a fixed time. It is also called a draft. Example, understanding with names. Imagine A sells goods to B on credit and wants to get paid later. A writes a bill of exchange saying, B must pay $5,000 to A or someone A chooses after 2 months. Signed, a drawer, the one who makes the bill. B, the one who must pay. A or C, payee, the person who receives the money. 3 short trick to remember. Use DDP, think of direct debit payment. Drawer writes the bill. Drawee pays the money. Payee receives the money. Direct debit payment. Easy to recall. Characteristics of a bill of exchange. A bill of exchange is a written order to pay money. It has specific features that make it valid. Simple explanation. Written document, it must be in writing. Order to pay. The drawee must be instructed to pay a certain sum. Drawee payer. A specific person must be responsible for payment. Signed by drawer. Without a signature, it's not valid. Unconditional. Payment must be guaranteed, not based on conditions. Parties. It must mention drawer, drawee, and payee clearly. Certain amount. The exact sum must be mentioned. No payment in kind. It must be paid in money only. No goods, services. Stamped. A bill needs a proper stamp as per Indian law. Not payable to bearer on demand. RBI prohibits issuing such bills. 2 example, understanding with names. Imagine A sells goods to B on credit. A wants to ensure he gets paid. B must pay $10,000 to A after 3 months. Signed, A drawer, writes the bill, pays the money. A or C, payee, receives the money. 3 short trick to remember. Use WADS CSPNS. Think of words cash payments. O, order to pay. D, drawee. S, signature of drawer. C, certainty of amount. Parties must be clear. N, no payment in kind. Shouldn't be payable to bearer on demand. WADS CSP equals words cash payments. Easy to recall. Parties to a bill of exchange. A bill of exchange involves 3 main parties. 1 simple explanation. Drawer maker. The person who writes creates the bill and asks for payment. Drawee payer. The person who is responsible for making the payment. Payee receiver. The person who gets the payment. 2 example, understanding with names. Imagine A sells goods to B on credit. A wants to ensure he gets paid. B must pay $10,000 to A or C after 3 months. Signed, creates the bill. B pays the money. A or C receives the money. 3 short trick to remember. Use DDP, roar, DE. Think of dost pays. Specimen of bill of exchange. A bill of exchange is a written order where one person asks another to pay a certain amount to a third person. It works like a formal IOU, but with a legal guarantee. 2. Example. Understanding with names. Sushil buyer buys goods worth $500 from Rakesh seller on credit. Rakesh also buys goods from Ram worth $500. Instead of paying separately, Rakesh orders Sushil to pay $500 directly to Ram. This written order is a bill of exchange. Think of it as a money shortcut. Instead of passing cash between multiple people, one direct payment is made. 3 short trick to remember. Use 3P rule. Payer, payee, presenter. Payer. Trick P3 money flow. Imagine money moving between 3 people directly. Difference between bill of exchange and promissory note. Simple explanation. A bill of exchange and a promissory note both deal with payments. but they have key differences. A bill of exchange is like an order. Hey, pay this person. A promissory note is a promise. I will pay you. Two key differences. Easy breakdown. Bill of exchange, promissory note. Know of parties. 3. Drawer, drawee, payee. Type. Order to pay, promise to pay. Liability. Conditional, absolute, who pays. Drawee, decker. Acceptance needed? Yes. No. Payable to bearer? Notice if not paid. Must inform all involved. No need to inform. Protest if dishonored? Required. Not required. Example for better understanding. Bill of exchange. Like a boss telling his employee to give money to a supplier. Promissory note. Like you signing a note saying you'll pay back a friend. Short trick to remember. Top clap NPP. T equals 3 parties. O equals order to pay. P equals pay can be drawer. C equals conditional liability. L equals liability of drawer. A acceptance needed. P equals payable to bearer. N equals no notice needed. P equals protest not needed. P equals promissory note has primary liability. Trick word, top clap. Imagine giving a top clap when you understand the difference. Checks, simple explanation. What is a check? A check is a special type of bill of exchange that is always drawn on a bank, is always payable on demand immediately when presented. Key point. All checks are bills of exchange, but not all bills of exchange are checks. Key features of a check. Written instrument must be in writing. Drawn on a banker. Only a bank can be asked to pay. Signed by the drawer. The person issuing the check must sign it. Order to pay. The bank is ordered to pay a specific amount. Immediate payment. No need for acceptance, unlike a bill of exchange. 3. Example for easy understanding. Example. You write a check for $10,000 and give it to your friend. Your friend takes it to your bank, and the bank pays $10,000. Short trick to remember. BOPS. B equals banker, O order to pay, P equals payable on demand, S equals signed by drawer. Trick word. Imagine a check BOPS money out of your account. Characteristics of a check. Simple explanation. 1. What is a check? A check is a written order directing a bank to pay a specific amount of money to a person or bearer on demand. Key characteristics of a check. Written document. It must be in writing. Order to pay. It must be a direct order, not just a request. Unconditional. Payment must not depend on any condition. Signed by drawer. The person issuing the check must sign it. Fixed amount. The amount must be clearly mentioned. Money only. It cannot order payment in goods or services. 3 parties. There must be a drawer, issuer, drawee, bank, and payee, receiver. Specific bank. The check must be drawn on a particular bank. Payable on demand. The bank must pay immediately when presented. 3. Example for easy understanding. Example. You write a check for $5,000 to your friend Amit. Your bank SBI pays $5,000 to Amit when he presents the check. 4. Short trick to remember. WOSS3P, O equals order to pay, S equals signed by drawer, S equals specific bank, S equals sum certain, P equals payable on demand, P equals pay money only. Trick word. Think of a check as a WOSP signal to the bank to pay instantly. Parties to a check. Simple explanation. 1. What is a check? A check is a written instruction to a bank to pay a certain amount to a person or bearer. 2. Who are the 3 main parties? Drawer, issuer. The person who writes issues the check and has an account in the bank. Example, you write a check to pay your friend Amit. Bank, the bank where the drawer has an account. The bank pays the money. Example, if you have an account in SBI, SBI is the drawee. Payee receiver, the person who gets the money. Example, your friend Amit who receives the money is the payee. 3. Example for easy understanding. Example, you write a check of $5,000 for Amit payee. Your bank will pay $5,000 to Amit when he presents the check. 4. Short trick to remember. DDP, D equals draw, PIP payee. Trick word, dip. Think of a check as a dip process. Drawer issues, drawee pays, payee receives. Types of checks. Simple explanation. What is a check? A check is a written order instructing a bank to pay a specific amount of money to a person or organization. 2. Different types of checks. 1. Open check, uncrossed check. A check that can be cashed at the bank counter. It can also be deposited in the bank account or given to another person by signing on the back. Example, you give an open check to your friend and he cashes it at the bank. 2. Crossed check. Safer than an open check. Cannot be cashed at the counter, must be deposited in the bank account. Marked with 2 parallel lines on the check. Example, if you issue a crossed check to your friend, he must deposit it in his bank account to get the money. 3. Bearer check. Whoever holds this check can get the money. No need for the payee's signature, can be transferred by simple delivery. Example, if you drop a bearer check, anyone who finds it can withdraw the money. Risky. 4. Order check. Paid only to a specific person mentioned on the check. Requires the payee's signature for further transfer. Example, if you write, pay to Ramesh, and cut the word bearer, only Ramesh can get the money. 3. Short trick to remember. B equals bearer, open equals crossed. Order. Think of checks as COBO, crossed for safety, open for flexibility, bearer for risk, order for security. Simple explanation. 1. What are other types of checks? Apart from open, crossed, bearer, and order checks, there are some special types of checks based on their condition and usage. 2. Different types of special checks. 1. Mutilated check. A check that is torn or damaged. If important details are missing, the bank will not accept it without the drawer's confirmation. Example, if you accidentally tear your check while opening an envelope, the bank may ask for your confirmation before processing it. 2. Stale check. A check that is older than 6 months from the issue date. Banks do not accept stale checks unless confirmed by the drawer. Example, you find an old check from last year in your drawer. It's now stale and cannot be used. 3. Antedated check. A check with an earlier date than the day it is presented, valid for up to 6 months from the date on the check. Example, you write a check on 20th May, but dated as 5th May, it's an antedated check. 4. Post-dated check. A check with a future date. Cannot be cashed before the mentioned date. Example, you write a check today, 8th May, but dated as 25th May, it's a post-dated check. The bank will process it only on or after 25th May. 5. Traveler's check. Issued by banks for people traveling to avoid carrying cash. Can be encashed at any branch of the issuing bank. Example, if you travel to another city, you can carry a 500 traveler's check instead of cash for safety. 3. Short trick to remember. Enk of these check mutilated, P equal post-dated, S equal stale, T, travelers. Trick word. Think of these checks as stamp. Stale for expired, travelers for safe travel, antedated for past date, mutilated for torn, post-dated for future. Specimen of a check. Simple explanation. A check specimen is just a sample format of how a check looks. It helps understand the important sections present on a check. 1. Key sections of a check. Key sections of a date. The day the check is written. Example 26/02/2025. 2. Payee name, the person or company receiving the money. Example, Rahul Sharma. Amount in words and figures. The check amount is written in numbers, 5,000, and words, 5,000 rupees only. 4. Account number, the bank account from which money will be deducted. Examples, 1147379211. 5. Bank name and branch, the bank issuing the check. Example, State Bank of India, Lucknow. 6. Signature, the account holder's signature to authorize payment. 7. IFSC code and Meyer code, used for online transactions and bank identification. Short trick to remember sections. DPass BI. P equals payee, A equal amount, S signature, S equals state bank name, B equals bank account number, I equals IFSC Meyer code. Trick word, DPass. Think of it as DPass for bank transactions. Date, pay, amount, signature, state bank, IFSC code. Rules for check. Simple explanation. Checks have specific rules that need to be followed to ensure that the payment goes smoothly. Let's break it down. 1. Key rules for checks. 1. Date. The date must be correct. Checks older than 3 months or with a future date will not be accepted. 2. Pay name. The name of the person or company receiving the check must be written clearly. 3. Account number. The drawer must mention the correct account number for the payment. 4. Minimum balance. The amount on the check should not exceed the balance in the account. There should also be a minimum balance in the account as per the bank's rules. 5. Crossing and overwriting. No crossing or overwriting allowed on the check. It should be clean. 6. Condition of the check. The check must be in good condition. If it's torn, wet, or spotted, the bank will not accept it. Signature. The signature on the check must match the one on the bank records. 8. Endorsement. If the check is crossed or ordered, it must be endorsed, signed by the payee properly for it to be transferred. 9. Amount in words and figures. The check amount must be written both in words and figures. They should match. True. Short trick to remember the rules. DPass. D, day equals payee, A equals account number, signature, C equals same amount, C crossing, equals endorsement. Trick word, DPass. Think of it as DPass for perfect checks. Date, payee, account number, signature, same amount, crossing, endorsement. Rules regarding crossing of checks. Simple explanation. When a check is crossed, it means 2 parallel lines, with or without words, are drawn on it. This ensures that the money goes directly to a bank account instead of being cashed at the counter. This is done for security purposes. 1. Key points about crossing a check. 1. 2 parallel lines. A check is crossed when 2 lines are drawn across its face. 2. Safer transactions. The money is deposited in a bank account instead of being given in cash. 3. Banker's responsibility. The bank must ensure the money is credited to the correct account. 4. Different forms of crossing. It can be written, stamped, printed, or perforated. 5. No direct cash payment. A cross check cannot be cashed at the bank counter. Short trick to remember the rules. PSBND. P equals parallel lines, T equals safe, equals banker's responsibility, D equals different forms. Trick word, bonds. Think of a check as a bond between the bank and the account holder to ensure safe transactions. Types and effects of check crossing. Simple explanation. Crossing a check means drawing 2 parallel lines on it. This makes the check safer by ensuring that the money goes to a bank account instead of being cashed at the counter. 1. Types of crossing and their effects. 1. General crossing, Sec 123. How? 2 parallel lines are drawn across the check. Effect? The check remains negotiable, meaning it can still be transferred. Example, if N & Co. or not negotiable is written between the lines, it still remains a general crossing. 2. Special crossing, Sec 124. How? The check has the bank's name written between the 2 lines. Effect? It can be deposited only in that specific bank's account for safety. Example, if Bank of India is written on the check, only an account in Bank of India can receive the payment. 3. Restrictive crossing. How? The words account payee or account payee only are written on the check. Effect, the money must go into the payee's account only. No one else can claim it. Example, if the check says AC payee only Bank of India, it can be deposited only into that specific person's account. 2. Short trick to remember. GSR, good safe rule. G equals general, S equals special, R restrictive. Trick word, think of a crossed check as a secure way to grasp your money safely. Who can cross a check? Simple explanation. A check can be crossed, adding 2 parallel lines, by different people to ensure security. 1. Who can cross a check? 1. Drawer, person issuing the check. The person writing the check can cross it, generally or specially. 2. Holder, person receiving the check. If the check is uncrossed, the holder can cross it generally or specially. If the check is already crossed, the holder can add not negotiable, making it safer. 3. Banker, bank processing the check. If a check is specially crossed, the bank can cross it again to another bank, its agent for collection. 2. Short trick to remember. DHB, drawer, holder, banker. Trick word, DHB, do have balance. Just like crossing ensures money reaches the right account, always do have balance in your account. Banker's check, simple explanation. A banker's check is a type of check that a bank issues on its own behalf to make payments. It is different from a normal check, which is issued by customers from their own accounts. 1 key points to remember. Issued by bank, not customers. Unlike regular checks, a banker's check is issued by the bank itself. The bank draws it on itself, pays from its own funds. For local payments only. Used only for payments within the same city. If someone doesn't have a bank account, the bank can still issue a banker's check for them. Safer than normal checks. It cannot be transferred, marked as not transferable. Must be paid at the issuing branch only. Used for large payments. Payments above $10,000 must be done using a banker's check. Demand drafts are not used for local payments, so banker's checks are preferred. Not a regular check. Though called banker's check, it is not covered under certain check laws, Sections 85A and 131A of the Negotiable Instruments Act. Example for easy understanding. Example, imagine Ravi wants to make a local payment of $20,000, but he doesn't have a bank account. The bank issues a banker's check in Ravi's name, and the receiver can cash it at the same bank branch. Unlike a personal check, there's no risk of it bouncing because the bank guarantees the payment. Short trick to remember. Blast. Banker's check is local, assured, safe, transfer restricted. Trick word. Blast. Banker's check is a blast for safe local payments. Between check and promissory note. A check and a promissory note are both used for payments, but they have key differences. 1. Key differences. Easy check. Promissory note. War. Drawer. Always issued on a bank, issued on a person or firm. Payable on demand. Always payable on demand. Can be payable on demand or at a fixed date. Stamp requirement. Must be stamped to be valid. Payable to bearer on demand. Can be payable to bearer on demand. Cannot be payable to bearer on demand. Crossing. Can be crossed for safer transactions. Countermanded stop payment. The drawer can stop payment before it is cashed. Cannot be stopped once issued. Acceptance. No acceptance required. Must be accepted by the person who promises to pay. 2. Example for better understanding. Example of a check. Ravi writes a check of 10,000 to Amit. Amit deposits the check, and the bank pays him. If Ravi wants to cancel the check, he can instruct the bank to stop payment before it's cashed. Example of a promissory note. Ravi gives a written promise to Amit stating, I promise to pay Amit 10,000 on 1st April 2025. Amit can claim the money only on that date. Once issued, Ravi cannot cancel it like a check. 3. Short trick to remember. Stamp C. Stop, time, acceptance, person, crossing. Trick word. The promissory note needs a stamp, a check doesn't. Check and bill of exchange. A check and a bill of exchange are both used for payments, but they have important differences. One key difference is easy explanation. Basis. Check. Bill of exchange. Drawer. Always issued on a bank. Issued on a person or firm. Payable on demand. Always payable on demand. Can be payables on demand or at a fixed date. Acceptance. No acceptance required. Must be accepted by the person who has to pay. No stamp required. Must be stamped to be valid. Grace period. No extra time for payment. Extra 3 days allowed for payment. Payable to bearer on demand. Can be payable to bearer on demand. Cannot be payable to bearer. Crossing. Can be crossed for safer transactions. Cannot be crossed. No notice required if check bounces. Notice is required if the bill is not paid. Countermanded. Stop payment. The drawer can stop payment before it is cashed. Cannot be stopped once issued. 2. Example for better understanding. Example of a check. Ravi writes a check of 10,000 to Amit. Amit deposits the check, and the bank pays him. If Ravi wants to cancel the check, he can instruct the bank to stop payment before it's cashed. Example of a bill of exchange. Ravi buys goods from Amit worth 10,000 but does not have cash now. Ravi gives a bill of exchange to Amit, stating, I will pay 10,000 after 30 days. Amit can cash the bill after 30 days, and Ravi cannot cancel it like a check. 3. Short trick to remember. Sing pack. Stamp, informing, notice, person, acceptance, crossing. Trick word. A bill of exchange needs a stamp. A check doesn't. Parties to a negotiable instrument. A negotiable instrument, like a check, promissory note, or bill of exchange, involves multiple parties. Some are original parties, like drawer, payee, and drawee, while others join later, like endorser, endorsee, and holder. 1. Who can be a party? Capacity of parties. Only a person who can legally enter a contract can be a party to a negotiable instrument. If someone cannot legally contract, they may not be liable, but others in the transaction might still be. 2. Who cannot be fully liable? Special cases. Can they be a party? Liability. Who pays? Kun. 1. Minor. Yes, but not liable. Minor's signature does not make them pay, but others in the transaction remain responsible. Insolvent. Yes, but estate pays. If bankrupt, their estate, controlled by a receiver, is responsible, but they personally are not. 3. Joint stock company. Yes, if authorized. If the company is not authorized by its memorandum of association, the instrument is invalid. 4. Agent. Yes, on behalf of another. Must clearly mention that they are signing as an agent, or else they are personally liable. 5. Legal representative. Yes, but must specify limits. If signing for a deceased person, must state liability is limited to the inherited estate. Otherwise, they may have to pay personally. Examples for better understanding. Example 1. Minor. A 17-year-old signs a promissory note. If he doesn't pay, he cannot be sued, but others, like co-signers, can. Example 2. Insolvent. A person declared bankrupt writes a check. The check may not be valid, but if endorsed earlier, the previous signers can still be held responsible. Example 3. Agent. An employee signs a check for a company. If they don't write for ABC Ltd, they personally owe the money instead of the company. Example 4. Legal representative. A son signs a check from his late father's account. If he writes with recourse to estate only, he won't be personally liable for any debts. Short trick to remember. Milaj, insolvent, legal representative, agent, joint stock company. Trick word, milaj. Some parties have limited liability in negotiable instruments. A holder is the person who legally owns a negotiable instrument, like a check or promissory note, and has the right to receive payment for it. 1. Who is a holder? A holder must meet two conditions: owns the instrument in their own name, has the right to receive payment from the person who owes money. Example: you receive a check from your friend in your name, you are the holder. You find a lost check on the street not in your name. You are not the holder. Two types of holders. Bearer instrument. The person who physically holds it is the holder. Order instrument. The payee, whose name is written, or the endorsee to whom it is transferred, is the holder. 3. Legal versus actual holder. Legal holder, recognized by law, has a right to claim payment. Actual holder, de facto, physically holds it but has no legal right to demand payment. Example: you legally receive a check in your name. De jure holder. You borrow someone's check to hold but it's not in your name. Not a holder. 4. English law versus English law must physically hold the instrument to be a holder. Indian law, physical possession is not required, only legal ownership matters. 5. Short trick to remember. Porn, possession, owner, right to payment, aim on it. Trick word. A holder must be the rightful owner with a right to receive payment in their name. In due course, Section 9. Simple explanation. A holder in due course, HDC, is a special type of holder who legally acquires a negotiable instrument under fair conditions and extra legal protection. Who is a holder in due course? A person becomes an HDC if they meet all these conditions: gives valuable consideration, paid money or provided a service for it, receives the instrument before its due date, before the check or note expires, gets the instrument in good faith without knowing it has any problems or fraud. 2. Difference between holder and holder in due course. Basis: holder in due course, HDC. Consideration: not necessary. Must pay or give something in return. Time of possession: any time before due date. Protection: limited, strong legal protection. Example: normal holder, you get a check as a gift from a friend. HDC, you buy a check from someone before its due date without knowing any issues. 3. Importance of being an HDC. Better legal protection. Even if the previous owner had issues like fraud, an HDC can still claim the money. Cannot be denied payment. The person who gave the instrument cannot refuse to pay an HDC. Short trick to remember. Gift, good faith, in time, for value, title clean. Trick word, gift. An HDC must get the instrument in good faith, in time, for value, and with a clean title. Qualifications of a holder in due course. Simple explanation. A holder in due course, HDC, must meet certain conditions to get special legal protection under the Negotiable Instruments Act. 1. Who qualifies as a holder in due course? To be an HDC, a person must fulfill these 5 conditions. Holder of the instrument. The person must legally possess the instrument in their own name and have the right to receive payment. Paid for it, consideration. The instrument must be acquired in exchange for something valuable, e.g., money, goods, services. A gift check does not make someone an HDC. Before due date, maturity. The instrument must be acquired before its maturity date. If someone gets it after maturity, they lose HDC rights. Complete and regular on the face. The instrument must look proper, correct details, date, signature, no visible defects. Taken in good faith. The person should not be aware of any fraud or defects in the title of the previous owner. Example for easy understanding. Valid HDC. You buy a check from a friend before its expiry without knowing that it was originally stolen. Since you meet all conditions, you can legally claim payment. Not an HDC. You accept a post-dated check as a gift from a relative. Since there is no consideration, you cannot claim HDC protection. Short trick to remember. Happy, holder, acquired before due date, paid for it, proper and complete, yes, taken in good faith. Trick word, happy. A holder in due course is always happy because they are legally protected. Privileges of a holder in due course, HDC. A holder in due course enjoys special legal protections when dealing with negotiable instruments, like checks, promissory notes, and bills of exchange. 1. Key privileges of an HDC. Instrument becomes clean. Any previous defects or fraud in the instrument do not affect the HDC, unless the HDC was involved in the fraud. Rights not affected by an incomplete instrument. If a check or bill was incomplete when issued, but later filled in with a higher amount, the HDC can still claim full payment. All prior parties are liable. The original drawer, acceptor, and endorsers must pay the HDC, even if they did not intend to. Can claim payment even from a fake bill. If both the drawer and payee of a bill are fake, but the signature is genuine, the acceptor still has to pay the HDC. No effect of conditional delivery. If a check was given with conditions, e.g., use only for loan repayment, but later transferred, the HDC can still claim full payment. Cannot refuse payment due to fraud. Even if the check was stolen or obtained by fraud, the person liable must still pay the HDC. Every holder is considered HDC. By default, the law assumes that every holder is an HDC unless proven otherwise. Cannot deny original validity. If the maker of a check or promissory note wrote it incorrectly, they cannot deny its validity later. Cannot deny payee's right to endorse. The issuer cannot refuse to pay by claiming the payee had no right to transfer the instrument. Endorser cannot deny prior signatures. If someone endorses, signs, and transfers a check, they cannot later say the previous signatures were fake or invalid. 2 example for easy understanding. Valid HDC case. A buys a check from B for $10,000 before maturity. B had stolen the check, but A did not know this. A is an HDC, so the bank must pay A. Not an HDC case. A finds a check on the road and tries to cash it. Since A did not pay for it, A is not an HDC and cannot enforce payment. Short trick to remember. Clean preliensed. Liability of prior parties. Every holder is HDC. Accepts even fake bills. No effect of fraud, presumed EC. Rights remain intact. Original validity stands. Ownership can't be denied. Forged signatures still bind parties. Trick word. An HDC is clean proof because they are legally protected from fraud and defects. Difference between holder and holder in due course. Simple explanation. Difference between holder and holder in due course. Simple explanation. A holder and a holder in due course, HDC, both have rights over a negotiable instrument, like a check, but an HDC has stronger legal protections. 1. Key differences. Basis holder in due a gift. Consider it. Can get the instrument without paying for it, e.g. as a gift. Must pay to acquire it. Before maturity can get the instrument after maturity. Must get it before maturity. Good faith can get the instrument even with suspicion of fraud. Must get it in good faith, no suspicion of fraud. Better title, have a better title than the person who gave it. Gets a better title than the transferor. Rights over prior parties, limited rights can claim only from the transferor. Strong rights can claim from all prior parties. Legal privileges, fewer legal protections, more legal protections under sections 20, 36, 42, etc. 2 example for easy understanding. Holder in due course, HDC case. A buys a check from B before maturity by paying for it. Later, A finds out that B got the check through fraud. Still, A can claim the check's full value as A is an HDC. Holder not HDC case. A receives a check as a gift from B. Later, B is found guilty of fraud. A cannot enforce full payment as A is only a holder, not an HDC. 3 short trick to remember. Big RP, before maturity, I in good faith, gets better title, rights over prior parties, privileges under law. Trick word, HDC gets a B, rights and privileges. Dishonor of negotiable instruments, simple explanation. A negotiable instrument, like a check, promissory note, or bill of exchange, is said to be dishonored when it is not accepted or not paid by the responsible party. This means the instrument loses its honor or credibility. 1. How can a negotiable instrument be dishonored? 1. Non-acceptance, only for bills of exchange. A bill of exchange must be accepted by the drawee, person who has to pay. If the drawee refuses to accept, the bill is dishonored. Example. A draws a bill on B for 10,000, asking B to accept and pay after 2 months. B refuses to accept the bill. The bill is dishonored due to non-acceptance. 2. Non-payment for all negotiable instruments. If the drawee, payer, does not pay when the instrument is presented, it is dishonored. This applies to checks, promissory notes, and bills of exchange. Example. A issues a check to B for 5,000. B deposits the check, but A has insufficient balance. The check is dishonored due to non-payment. 2 short trick to remember. NANP, non-acceptance, non-payment. Trick word. If payment is not made, the instrument takes a nap, dishonored. Dishonor of a bill of exchange by non-acceptance, Section 91. Simple explanation. A bill of exchange is a document that asks a person, drawee, to pay a certain amount to another person, payee. If the drawee refuses to accept the bill, it is called dishonor by non-acceptance. 1. When is a bill dishonored by non-acceptance? 1. Drawee does not accept within 48 hours, chas. The bill must be accepted within 48 hours of being shown. If the drawee does not accept within this time, the bill is dishonored. Example. A gives a bill to B, asking him to pay 10,000 after 2 months. B does not accept the bill within 48 hours. Dishonored. 2. Multiple drawees. Not all accept. If there are many drawees who are not partners, and not all of them accept, the bill is dishonored. Example. A gives a bill to B, C, and D. Only B and C accept, but D refuses. Dishonored. 3. Presentment not required, still not accepted. Sometimes a bill doesn't need to be presented for acceptance, e.g. if the drawee has already agreed. If, despite this, the drawee does not accept, it is dishonored. 4. Drawee is not legally fit to contract. If the drawee cannot enter into a contract, e.g. minor, mentally unfit, the bill is dishonored. 5. Drawee gives a conditional acceptance. If the drawee accepts the bill with conditions, I will pay only if I receive goods, it is dishonored. 6. Drawee is fake or missing. If the drawee does not exist or cannot be found, the bill is dishonored. 7. Drawee in case of need also dishonors. Sometimes a bill has a backup drawee in case of need. If even this drawee does not accept, the bill is dishonored. Short trick to remember. MAD FQF, multiple drawees, acceptance delay, D, drawee missing, Fness to contract, qualified acceptance, fake drawee. Trick word, MAD FAQ. If a bill is dishonored, people ask a lot of MAD FAQs. Dishonor by non-payment, Section 92. Simple explanation. A negotiable instrument, like a check, bill of exchange, or promissory note, is said to be dishonored by non-payment when the person responsible fails to pay the amount when required. 1. When is a negotiable instrument dishonored by non-payment? 1. Failure to pay by the responsible person. The person who is supposed to pay, maker, drawee, or acceptor, does not pay when asked. This leads to dishonor. Example, A gives a check to B for $5,000. When B presents it to the bank, there is no money in A's account. Dishonored check. 2. Bill remains unpaid at or after maturity. If a bill reaches maturity, due date, and is not paid, it is dishonored. Even if the bill does not need to be presented for payment but remains unpaid, it is still dishonored. Example, A gives B a promissory note saying, I will pay $10,000 after 3 months. After 3 months, A does not pay, dishonored promissory note. 2. Short trick to remember. FM, failure to pay, maturity date passed. Trick word, FM radio. If payment is dishonored, people make a lot of noise, just like FM radio. Consequences of dishonor, simple explanation. When a negotiable instrument, like a check, bill of exchange, or promissory note, is dishonored, not accepted or not paid, the person holding it, holder, can take action. 1. What happens after dishonor? 1. Right to file a case. The holder can sue the person responsible for payment. This helps recover the due amount. Example, A gives a check to B for $10,000. The check bounces, not enough balance. B can file a case against A. 2. Must inform the liable parties. The holder must send a notice to the person responsible. This is necessary before taking legal action, except in some cases. Example, B, holder, sends a notice to A before filing a lawsuit. 3. Can get official proof from a notary. The holder can get the dishonor recorded by a notary public. This makes it a legal proof that the payment was refused. Example, B goes to a notary who officially notes that A's check bounced. Short trick to remember. L, lawsuit proof. Trick word, lamp. If a check is dishonored, the holder lights a lamp. Lawsuit alert notice. Make proof. Notice of dishonor, simple explanation. When a negotiable instrument, check, bill of exchange, promissory note, is dishonored, not accepted or not paid, the holder must inform the responsible parties. 1. What is notice of dishonor? It is a formal warning. The holder must send a notice to make the responsible parties liable. If he does not send it, those parties are freed from liability, except in some cases. Example, A gives a check to B. The check bounces, no balance. B sends a notice to A warning that legal action can be taken. #2. Who can give and receive notice? Given by the holder, person having the instrument, any other party on the instrument, like an endorser to prior parties. Given to all prior parties who might be responsible for payment. Not required for the maker in promissory notes, acceptor, bill checks because they are already liable. Example, B holder sends a notice to C endorser, but does not need to send it to A. 3. How and when to give notice. Form of notice can be oral or written, can be sent by post or given in person. Must clearly state that the instrument was dishonored. Timing must be given within a reasonable time, sent to the business or home address of the concerned party. Example, B sends a written notice to C within 2 days at his office. 4. Short trick to remember. GTF, give notice, time matters, formal or informal. Trick word, gift. Think of notice as a gift. Give notice, inform in time. Discharge of negotiable instruments, simple explanation. When a negotiable instrument, like a check, bill of exchange, or promissory note, is discharged, it means it is no longer valid for transactions. No one can claim money on it anymore. There are 2 types of discharge. 1. Discharge of the instrument. The instrument itself is no longer usable. 2. Discharge of parties. Some people involved in the transaction are released from liability. When is an instrument discharged? The instrument is discharged when the last person responsible for payment pays the full amount. No one can use it for further transactions. Example, A gives a check to B. B deposits it, and the bank clears the payment. Now, the check is discharged, cannot be used again. Ways a negotiable instrument is discharged. A. By payment in due course. If the right person, maker, acceptor pays the full amount at the right time, the instrument is discharged. If paid before maturity, it is not discharged unless canceled or recorded. Example, if A gives B a check and B receives the money from A's bank at maturity, the check is discharged. B, by cancellation. If the holder cancels the name of the acceptor or endorser intentionally, the instrument is discharged. Example, if B holder strikes off A's name on a promissory note, A is released from liability. C, by party primarily liable becoming holder. If the main person responsible for payment gets back the instrument, it is discharged. This is called negotiation back, like buying back your own check. Example, A issues a bill of exchange to B. Later, A buys it back from B. Now it is discharged. D, by express waiver. If the holder gives up all rights on the instrument in writing, it is discharged. Example, B holds a check from A but writes a letter saying he won't claim money. The check is discharged. E, by discharge as a simple contract. Just like a regular contract, a negotiable instrument can be discharged by novation, replacing with a new contract, rescission, canceling the contract, expiry of limitation period, time limit for claiming money ends. Example, A gave B a check, but B waited too long to claim it. If the legal time limit expires, the check is discharged. 3. Short trick to remember. PCPWS. Payment, C cancellation, primarily liable party, waiver, simple contract. Trick word. PC wins. Imagine the PC winning by getting the instrument discharged. Discharge of parties from liability, simple explanation. What does discharge of parties mean? When a party is discharged, they are no longer responsible for paying or fulfilling obligations on the negotiable instrument, like a check, promissory note, or bill of exchange. However, the instrument can still be used by other undischarged parties. Ways a party can be discharged from liability. 1. By payment in due course. If the main person responsible, maker, acceptor, pays the full amount, other parties are discharged. Example, A gives a check to B. If B receives the full payment, A is discharged. 2. By cancellation. If the holder intentionally cancels a party's name, endorser, acceptor, that party is discharged. Example, B has a promissory note signed by A. If B strikes off A's name, A is discharged. 3. By release of party. If the holder signs a written agreement stating that a party is free from liability, that party is discharged. Example, A issues a check to B, but later B signs a letter saying A does not owe money anymore. A is discharged. 4. By material alteration. If someone changes important details on the instrument, like amount, date, name, all parties except the one who made the change are discharged. Example, A issues a check for $10,000. If B changes it to $50,000, A is discharged because of fraud. 5. By negotiation back. If the original maker of the instrument receives it back, they are discharged. Example, A issues a bill of exchange to B. Later, A buys it back from C. A is discharged. 6. By expiry of limitation period. If the legal time limit to claim payment is over, the party is discharged. Example, A gave a check to B, but B waited too long, beyond 3 months. Now, A is discharged. Now, short trick to remember. PCRMNE, C cancellation, release, material alteration, negotiation back, expiry. Trick word. Imagine a prince who is discharged from his royal duties. Modes of discharge of parties from liability. What does this mean? A party, maker, acceptor, or endorser, is freed from responsibility for paying the negotiable instrument, like a check or promissory note, in certain situations. Ways a party can be discharged. 1. By payment. If the payment is made correctly and completely, the instrument and all parties are discharged. Example, you give a check to your friend, and they cash it. Check cleared, no liability. 2. By cancellation. If the holder intentionally cancels a party's name, that party is discharged. Example, you hold a promissory note signed by A. If you strike off A's name, A is discharged. 3. By release. A party is freed by a separate written agreement, not just cancellation. Example, B owes $5,000 to A. Signs a waiver saying B does not need to pay. B is discharged. 4. By allowing more than 48 hours for acceptance. If a bill of exchange drawee, person who needs to pay, gets more than 48 hours to decide, parties who didn't agree are discharged. 5. By taking qualified acceptance. If the holder accepts partial, conditional payment without consent from all prior parties, those parties are discharged. 6. By not giving notice of dishonor. If a check bill is dishonored but no formal notice is sent, other liable parties are freed. Example, a check bounces, but the bank does not inform the drawer. The drawer is discharged. 7. By non-presentation for acceptance. If a bill of exchange is not presented for acceptance on time, endorsers in the drawer are discharged. 8. By delay in presenting a check. If a check is not deposited in time and the bank fails, the drawer is not responsible. Example, a check is given in January but deposited in May. Meanwhile, the bank closes. The drawer is discharged. 9. By draft between bank branches. If a bank drafts a check on its own branch and it gets paid, the bank is discharged. 10. By material alteration. If important details are changed, amount, date, name, etc., all parties except the one who altered it are discharged. Example, a check of $1,000 is changed to $10,000. The issuer is discharged. Short trick to remember. PCR 48QNNDBM. Payment, cancellation, R release 48 hours, Q qualified acceptance, notice, non-presentation, delay, bank draft. Trick word, Prince QBN. Imagine a prince who is discharged from his royal duties. Difference between discharge of an instrument and discharge of a party. What does this mean? There are 2 types of discharge in negotiable instruments. 1. Discharge of the instrument. The entire instrument becomes invalid. 2. Discharge of a party. Only a particular person is freed, but the instrument remains valid. Key differences. Basis. Discharge of an instrument. Discharge of a party. When it happens. When the final responsible person is freed. When any single party is freed. 2. Negotiability. The instrument stops being negotiable, can't be used anymore. The instrument remains negotiable, others can still use it. 3. Legal rights. All rights end, nobody can claim money from it. Some rights remain. Other parties may still be responsible. Effect on parties. All parties are freed from paying. Only one person is freed. Others may still be liable. Simple example. Discharge of an instrument. A check of $10,000 is paid and cleared. No one owes money now. Result? The check is useless now. Discharge of a party. A bill of exchange has 3 signatories, A, B, and C. The holder frees B from liability, but A and C still owe money. Result? The bill is still valid, but only A and C are responsible. Short trick to remember. Stabinad, when, negotiability, action, discharge. Trick word. Think of a magician's wand. It can remove discharge the whole instrument or just one party. Quick Guide to Negotiable Instruments Act, 1881. What is the Negotiable Instruments Act, 1881? This law governs financial documents like checks, bills of exchange, and promissory notes used in business transactions. It ensures safe, quick, and legal money transfers. Types of negotiable instruments. 1. Promissory note, a written promise to pay money. Example, I, Rahul, promise to pay $10,000 to Aman on the 1st March. 2. Bill of exchange, an order by one person to another to pay money. Example, a supplier orders a buyer to pay $50,000 in 30 days. Check, a written order to a bank to pay money. Example, a signed check given to a shopkeeper for payment. Difference, bill of exchange versus promissory note. Feature, bill of exchange. Promissory note, accepted. Number of parties, 3, drawer, drawee, payee. 2, who orders payment, drawer orders drawee to pay, maker promises to pay. Accepted must be accepted by drawee, no acceptance needed. Hatch parties to a bill of exchange. 1, drawer, person who writes the bill. 2, drawee, person who pays the bill. 3, payee, person who receives the money. Types of checks. 1, bearer check, anyone holding it can encash it. 2, order check, only a specific person can encash it. 3, crossed check, can only be deposited in a bank account. 4, post-dated check, dated for a future payment. Holder versus holder in due course feature. Holder in due course. Who is it? Anyone in possession of the instrument, a person who gets it legally before its due date. Rights, limited rights, full legal rights. Discharge of negotiable instruments. When a negotiable instrument loses its validity and no one is liable to pay. Modes of discharge. Payment, full payment is made. Cancellation, name of the liable party is struck off. Release, a written statement frees a party. Material alteration, any major changes make it invalid. Short trick to remember. BPHC, RHD, ISNISPers have C-clear rules handling debts. Bill of exchange, promissory note, older and holder in due course. Chick types, how parties are discharged. Difference between bills and notes. Use this trick to quickly recall important topics during exams. Hash 6.9. Exercise 9.1. Short answer type questions. 1. What do you understand by the Negotiable Instrument Act, 1881? 2. Discuss the types of negotiable instruments. Differentiate between bills of exchange and promissory note. 4. State the parties to a bill of exchange. 5. Explain the types of checks. 6. Discuss the concept of holder and holder in due course. Differentiate between holder and holder in due course. ASHA 6.9.2. Long answer type questions. 1. What do you mean by negotiable instruments? Discuss the characteristics of negotiable instruments. 2. Enumerate the various types of negotiable instruments. 3. What is a bill of exchange? What are its essential characteristics? 4. Define a promissory note. Who are the parties to a promissory note? 5. What are the rules related to the crossing of checks? 6. Define check. What are its essential characteristics? How does it differ from a bill of exchange? 7. Enumerate the qualification and privileges of a holder in due course. 8. Explain the discharge of a negotiable instrument. Also, describe the various modes of discharge of parties from liabilities.